So I'm a venture capitalist. My job is to raise money from investors, identify companies, invest in them, nurture them to be successful, and then have an exit to give profit back to my investors. Imagine if I went to every property owner and I convinced them, take 1% of what you have in property, go to your bank and ask them to increase the amount of the mortgage, 1% of the asset value. Most banks would look at it and go, whatever, now you have a new mortgage bill. It's that money plus 7% or whatever the rate is. Take that money that you just got from them and give it to me and I'm going to invest it in venture.
So thanks for coming on the pod, Mark. And do you want to give us a little TLDR on you, perhaps?
It probably will be too long. So I'm an American, and
really,
surprisingly, an American, U.S. American. We have to be careful now because the Canadians get offended.
Oh, okay.
They're North Americans as well.
Mm-hmm.
I've been coming to New Zealand since the first time I was here was in 1974. You might not remember that.
No.
Probably not. I was a teenager and my family was here for a few weeks on one extended holiday. It was a very different country in those days.
Right.
But I started coming here regularly in the early 90s, probably 93, 94, around that time, maybe mid-90s.
Just around for that.
You were just around.
Just arrived on the planet.
You were not the person I was coming to see.
No. And I wasn't actually here. I was actually in the UK.
Well, there you go. I grew up in the UK when I was a kid. And so
Where?
I had in Camberley in Surrey.
Oh my gosh. No, I know.
You weren't born in Woking, were you?
I was born in Chatham in Kent.
Oh, my brother was born in Woking. My goodness.
But one of my good friends was from Camberley, and my wife's parents live in Aldershot.
Oh, yes,
and
very well.
I was from Sussex.
Oh, okay.
So that's where I grew up. Yeah.
So I think having lived in England gives me an advantage in now living in New Zealand. I'll come back to that.
Okay.
But then I was coming here because I was working for IBM at the time. I had risen to a certain level, executive level, and one of the responsibilities was to be a partnership or relationship executive to large customers around the globe. And when I got to that level, I got promoted when I came back from 3.5 years assignment in Japan, where I was flying from Osaka back to New York like every other month. So someone who was in the assigning role said, oh, this guy likes long flights. Let's assign him some customers. I was in New York. Let's assign him some customers in Australia. So I go to Australia 3 times a year, meet with, that time it was Telstra, Macquarie Bank, and AMP, the insurance company. And it was really an interesting model. The idea was to meet with executives, talk about strategy, long-term view. Well, I wasn't there to sell them anything. The sales team could, but I was there to build a relationship. And the New Zealand sales team for IBM, which was a very small team at the time, got wind of this and sent me an email and said, oh, next time you come, would you come to New Zealand? Because the executives won't come here, or if they do come here, they don't tell us because they're here fly fishing, so they don't want us to know. I said, sure, it's fine. So I started coming here around that time, and I would meet with Telecom, Air New Zealand, BNZ, still a New Zealand bank, and the Dairy Cooperative Board, the predecessor to Fonterra. And when I was in Australia, I'd be there a week, and they would just pack my schedule. It's, okay, you met with those 4, but now we're going to have you meet with the Small Business Council, you're going to meet with these journalists, you're going to do this thing with the state government of South Australia, or fly over there, whatever it was. So I had my meetings with those New Zealand customers, and I said to the team, now, who are we meeting with now? Well, what do you mean? So, well, keep you busy. Oh, no, you can go sightseeing and do it. No, I'm here for work. All our other customers just buy typewriters. I don't think they need an executive sponsor. New Zealand was a very small business country at the time, even more than today. So that was interesting. In the late 90s, I got, by the sales team, introduced to Team New Zealand. I was a sailor actually on the East Coast of the US and a member of the dreaded New York Yacht Club, which was trying to win the cup back. But I met with them because there was a thought that we might want to be a technical sponsor. IBM might be a technical sponsor for Team New Zealand. And that never happened, but it meant I was here a lot more often over a short period of time, including bringing my family here for a holiday at the end of the year, probably 97 or 8. And I met some folks in Central Otago who I also like wine, as many people. Met some winemakers, and one of them started a dialogue with me about this development. They were going to build a new vineyard and all that. So I got involved in that and ended up investing in property in 99 in central Otago, part of the Amisfield vineyard.
It's a beautiful vineyard.
Well, it was just rabbit land when I invested, but now it's a vineyard and a very good wine. So that cemented my connection. Even after I left IBM, I had a good excuse to keep coming back. So I've had a long connection in New Zealand, and I worked for IBM, and then I left IBM, went to a startup. I didn't want to, I couldn't see myself spending another 25 years doing the same job. So I went to a startup. I went from having about 2,500 employees to having 35. That was interesting. And from having a multi-billion-dollar revenue to zero, having a budget, we went out of business, as they do. And then I moved to the West Coast, to Silicon Valley, and worked for a number of different companies. And because once I was in the Bay Area, I started seeing a lot of the Kiwi entrepreneurs, because if you were a startup entrepreneur in those days and you came to the US, you were definitely coming to San Francisco. And so I get emails from people, hey, my mate says that I should talk to you. I'm going to be in San Francisco. I've got this startup, we have a coffee. So I'm following what was happening, very slow at the beginning, and it grew and grew and grew. And then in 2018, I left a corporate role in the US and decided I didn't want to do another one of those. And being in Silicon Valley, I'd become quite involved with the tech startup ecosystem and wanted to work with startups, but I didn't want to do that in the US. I think the Bay Area in particular, but the US in general, has kind of lost the plot on particularly early stage venture.
Okay.
We'll come back to that. So I said, I'm going to go to New Zealand and see what's going on down there, because I have this sense, this is 2018, that New Zealand is like the Nordic countries or Israel even earlier, about to go through an inflection point, and this sort of tech startup ecosystem is going to become something meaningful. It's been kind of bubbling along, but it's right at that threshold. And my US friends, many of whom were in venture, all thought I was an idiot. They said, you're an idiot. There's nothing going on in New Zealand. No one's ever heard of a New Zealand company. It's ridiculous. I looked around, I said, these are VCs, 2018. You're all wearing Allbirds, because they were, with their Patagonia vests.
Right.
They said, yeah. I said, that's a New Zealand company. Oh, it is? I didn't know that. And I said, you guys have heard of Xero, right? Oh, you mean the Australian accounting? No, it's not Australian. They had no clue. So I said, I'm not going to listen to you. So I came down here, and in a matter, mostly to talk myself out of this.
Right.
Because when you launch a venture fund, it's a 10-year commitment. You don't start it and then a few years later say, it's not much fun, I'll quit. You can't do that. And so I was hoping I'd find a reason to not do it, and then I can do something else. But it was really compelling. There was lots of interesting startup activity. The other part of my thesis was that these companies would need help to get to the US market, because it's a big, complicated market. They don't have a network. They don't know the people. And I would sort of split my time and be able to help them. And what I found out was all of that was true. Amazing companies, great ideas, naive, inexperienced, didn't know how to come to the big markets. I can help with that. And a shortage of capital, which I had not known. So they were very welcoming. The venture community wanted more people to come in, unlike Silicon Valley, where it's like, hey, we got enough already, get out. So I started investing and launched a fund here. So that's what I've been doing sort of full time for the last 5 years. And I was going back and forth, 2018 to 2019, be here about a month at a time, 3 or 4 times a year. I was coming here supposed to be here March 20th, I think. March 14th, we had a lockdown in San Francisco. And I said, maybe I'm going to wait it out, because everyone was saying it'll be a few weeks. And I got locked out. But I'd already gotten far enough along and done enough in a few investments. Didn't actually launch my fund until 2021, technically with outside money. But I was able to do it all from there with Zoom, and basically 6 hours a day for 4 or 5 days a week. And we did about probably 12 investments. When I say we, it's really me, of course, my limited partner investors. And I had one person I was working with as sort of a analyst who was based in the US. So that's what I've been doing. Now, I moved here a year and a half ago, full time. I finally, after COVID, I was on the first flight, literally the first one after the border opened. I remember taking off, and the pilot leaves late in the day, and the pilot got on and said, ladies and gentlemen, we're about to depart, and I just want to warn you that the border opens at midnight. It's not midnight in New Zealand, and so there's some possibility that we may be diverted.
Oh, wow.
Because the government could have changed its mind.
Yeah.
I went to sleep. I said, whatever, tell me when we get there. And we got in. And So I just went back to that same pattern. And then about a year and a half ago, or beginning of 2023, very beginning, I was here for 7 weeks during some of the best summer weather you've ever had, both cyclones. Completely disrupted my travel. And at the end of 7 weeks, I had been in Auckland 5 times, Wellington 4 times, Christchurch 4 times, Nelson twice, Palmerston North only once, Hamilton twice, and a few other places.
Mm.
And I'd only slept in the same bed 3 nights in a row twice out of 7 weeks. I said, this isn't a good model. I should just move here. And then when I need to go to the US, I'll do that. So that's what I did in early or middle of 2023.
Yeah.
I'm here full time now. So that's also given me a lot of different observations about the ecosystem and the culture. And you mentioned you want to talk about wealth. I have a lot of opinions on wealth management, and even some data that I think is surprising to a lot of people here.
Okay.
As well as opinions.
Sure. What would you start off in terms of that data then?
Okay, so I'm a venture capitalist.
Yep.
My job is to raise money from investors and then invest in identify companies, invest in them, nurture them to be successful, and then have an exit to give profit back to my investors.
Mm-hmm.
If you look across venture capital as an asset class, it has a really good average return. You know, if you look on average, it's like 15%.
Yeah, look, it's deceiving though.
Well, it's deceiving because people look at individual funds. If you spread your money across the whole asset class, you get a good return. Give everyone $1. So that's one of the things that is already important and not understood very well in New Zealand, in my opinion, which is portfolio management.
Okay.
Kiwis, when I talk to them, they go, I absolutely love investing in startups, but I like to pick my own. I'm going to put all my money in that one. That's very risky. No, I picked it. But then they lose their money and then they don't like it anymore.
Yeah.
Whereas investing in a fund, you get diversification. Invest in multiple funds, even more so. So that's one dimension. But the real problem is when I talk to people, random Kiwis, not people that are involved directly in the investment world or venture or whatever, and I start talking about this, go, oh yeah, well, venture is very risky. Well, why do you think we just don't have much capital? Well, we're a very poor nation and we're small. Really? We're poor? Doesn't feel that way. How poor are we? So I decided we have this thing called the internet. You can figure this out. If you rank order countries in terms of investable wealth per capita.
Okay, investable wealth.
Investable wealth per capita, 1 to about 140. They don't go below that. I think 140 is probably like Sudan or something. Where do you think New Zealand ranks in that list, approximately?
8th.
That's very specific.
That's very definitive.
I would have put us more around 30-ish.
That's what people say.
Yeah.
8th is a very good guess, but you're wrong. It's 6th.
Oh,
Damn it.
wow.
But 8th is very good. Most Kiwis would say 20, 30, I don't know. And then you look at the list and say, well, who's below us? France, Germany, Austria, UK. What?
Yeah.
Where's all that money? It's not in venture.
It's in property.
It's in property. So then I go, okay.
Well, then that capital's not technically investable capital.
It is investable because people invest in it. It's not primary residence necessarily.
But it's also not liquid, so is it?
Well, I didn't ask about liquid because if you put money in my fund, it's not liquid, but that was investable capital.
Yeah. Okay.
Same thing.
Yeah,
It's less liquid. You can decide to sell your house in 5 years. You can't decide to get your money back in 5 years. It's a 10-year contract, and when I give it to you, you get it.
Yeah.
So it's not a liquidity question. This is not the money that you use to live on and pay your bills every week. Or every month.
That's right. So it's basically assets that are allocated to marketable assets.
Yeah.
That could have otherwise
You could have put them somewhere else.
Allocated elsewhere.
But you weren't going to spend them to pay for your lunch today.
Yeah.
Exactly. So here's a math question for you. I'm a physicist, so I think this way.
Sure.
So if you can build $1 billion businesses with 10 people, which I'm not disputing, then it strikes me that you have one of two possibilities.
Yeah.
One of which is you're sucking up all the value and you're creating a bigger and bigger wealth gap.
Mm-hmm.
Or you're not, in which case you're creating a house of cards.
Okay.
Well, what I mean by that is you've got 8 billion people that need jobs.
Yeah.
If 8 billion people at 10 at a time build $1 billion businesses, that's a massive amount of wealth creation. How does that stay afloat? Or does it all collapse down in valuation? We live in caves.
Well, I think
Which I think we're headed towards if we're not careful.
Yeah, well, I think, yes, in terms of, I guess, so when I would say $1 billion business, I would say that there is a rational conversation about ultimately the free cash flow, the revenues, and the profitability of the business to get to a $1 billion business. You could argue that a 10x multiple on revenue, which is kind of, I'd say, the standard venture multiple at the moment, especially if you looked across kind of the globe and took an average, would be around that. If you look at software companies that are public.
Okay, so that's $100 million.
Yeah.
So every 10 people have to be spending a tenth of $100 million if they're all employed in businesses like that.
Yeah.
That means the average employee's income, not asset value, has to be a tenth of $100 million. They each have to make $10 million. Where's that coming from?
Well, they don't necessarily need to, right? They don't need
the money has to come from somewhere.
We're talking about valuation here, right?
No,
based on value, but you're not going to say that. You can't say that 10% of the revenue is going to go directly to the customer. It's also serving the customer to the employee. It's also going to serve the customers. It's going to be server costs.
But ultimately, the money is coming from somewhere. If it's going to the server costs, their employees in those 10 people are making all the money.
True. I mean, I'm not saying that every business will be a 10
billion. No, it won't be. That's why I said so that just disproved my theory. So then it's going to be the other way, which is all the money's going to go to a small number of people who have $1 billion businesses.
Well, I think
which is the path we're on.
Yes.
That's when it's going to create a small
caves.
Yeah,
that's an interesting one. I guess I'm thinking of it from.
You're absolutely right. If you take the small view of the
people you
high value, yes,
but
it can't work across and I don't mean global in the sense of the globe, I mean in the large scale.
It seems to me, based on what I can see, is that it is possible to do that, and we've seen it in.
Can one build that business? Absolutely.
Yes.
Yes.
So I think it's possible. I think that then, if that is possible, you should focus on enabling the people that are working on the business to get a fair.
I not disagree.
Ownership, equity. Now, we don't know how many investors and other stakeholders that are involved but not working in the business, right? So that could be distributed across 1,000 people, which have then equity stakes. So taking those views.
But the equity stakes, to your point, is your asset base. It's not your cash base. People have to eat, and they have to procure those services in order for you to get the revenue to have the valuation.
Yeah, so you have to be profitable.
But so where does that come from?
That comes from you being able to deliver. Well, that's really interesting.
Yeah, right? That comes from the workers. And this is the flaw in essentially the neo-capitalist model.
Because you're saying that all of the wealth is basically being distributed to 10 people.
Let's call it. The real problem is that we're creating wealth from assets rather than wealth from work.
Yes.
And that's always been true.
Yes.
The king owned the castle. That was their wealth.
Yeah.
I had to farm the land. Mine was labor.
Yeah.
And there was a mismatch.
Yeah.
And that mismatch collapsed for a long time, over a long time, to a better balance.
Right.
And now it's going very rapidly the other way. And what you're talking about is exacerbating that.
And I would say that based on what I'm seeing, it seems to me like that is the trend.
Right.
Yeah.
So is global warming. Should we just go with it and let's burn some more coal because we can accelerate it? Or should we say, whoa, this is a bad idea?
Yeah, so it's interesting.
So then what? So what do you do then?
Yeah.
Well, what you do then is you end up with, Elon Musk owns everything.
Yes, but what do we do to try and balance that out or bring it back to the way we think it should be?
This was one of the debates ill-formed that drove the US elections, which is if we believe, as I do, this is my communist side.
Yeah.
It's not communist. But
we got there in 20 odd minutes. I'm keen on this.
So here's my fundamental belief. Yes. I want to live in a society that I want to live in. Mm. And for me, that means I want to be able to go to the coffee shop and there's somebody behind the counter who's making minimum wage, but I want them to be happy and comfortable and not in fear, because it makes my day better when they're making me a nice coffee and they're happy about it.
Yeah.
And I could be a billionaire and I'd still feel that way.
Yeah.
But a lot of people don't, because there's a view that's a very isolationist or libertarian or whatever the right word is, view that says, I'm fine, screw everyone else.
Yeah, well,
that's their problem. And that is unfortunately what's driven by, I'm not picking on you.
No, I like
but
it.
That is highly aligned with that view. It doesn't have to be.
Yes.
Because you could go back and say, it's wonderful you're doing all that, and you are one of those top 1%. You're going to pay a lot of tax to make sure our society is well balanced. And it keeps you happy because now that barista knows that their kids, I'm making $20 an hour or whatever the minimum wage is, but their kids can go to university and become doctors and lawyers or whatever they want to do, or you can become a surfer because there's medical coverage or that
so
collapsed.
I think both things can be true, right? You can have large businesses created from a small group of people that create a highly efficient business, and those businesses and business leaders can then create abundance for, and I am of the view that actually I would rather live in a more micro world. So for example, I live in a specific suburb. Like, I believe that you need micro community in order to thrive. So then it should be incumbent on those equity owners to then make sure that their immediate and surrounding communities are thriving.
They do that. In South Africa,
right?
You can live in a fantastic community. Soweto's over there, and those people didn't manage to make it because and we don't live there because that's a shitty place to live. So we support our community. Screw them. And that's happening in the U.S. and it's happening even here.
So what's your how do you propose a solution to that? Because in my head, my naive head, I go, well, I'm one person, therefore I can probably only take care of or kind of robustly support as wide as my vision is, right? Which could be 3 suburbs wide, 5 suburbs wide.
Well, but think about back to your numbers. If there are 10 of us and we're the owners of $1 billion business or a large fraction of it, let's say we own 10% of it.
Sure.
The 10 of us each have $10 million.
Yeah.
Should we keep that all to ourselves, or should we sit there and go, I understand there's like a 50% tax at this level, which would be a lot less if I only made $1 million, and even less. And then there's an allocation process. Now, the allocation process is problematic.
Yes.
If you don't have the proper sort of robust democratic models.
Yeah.
That's a different problem.
Yes.
And so what's happening is people who are able to accumulate those assets say, I don't think these guys know how to distribute. I just want to keep it myself. But the reality is, and I can't think of the author's name and it's unpronounceable anyway, wrote a book a few years ago on this topic. When you actually look at the one argument is, well, you're going to have all that money, but you're going to be very philanthropic, and that's a good model. Turns out it doesn't work very well.
Yeah.
Actually.
Yeah.
And so the allocations aren't right. Maybe you really like birds. Now the birds are getting $1 million a year of bird charity.
Yeah.
But someone's starving down the street.
So
you need an allocation system that is different. And I don't know the answer to that.
Yeah.
But we ought to be working on that
problem.
problem. It is a difficult problem.
Do you think the living wage goes a small step towards?
Well, a living wage goes a small step. I think there are things that can be done. I mean, this is where this is now getting very much into the political realm.
Okay.
Things like collective bargaining. I mean, unions allowed people to get a decent participation in the cash or in the value creation as opposed to being left aside. There are issues like that. I mean, people have talked about what do they call universal basic income?
Yeah.
I don't know if that's a good idea or not. We should find out. We should do the experiments. There's some
experiments.
There are some experiments, and they look promising. But I'll give you 2 examples from my own personal life.
Yeah.
One of them is a person that I know reasonably well, not super well. I've been on a lot of bike trips with him. One of our bike trips was just before the first Trump election.
Yeah.
We were in Europe with a bunch of Europeans. There were only a couple of Americans. And one of the Europeans asked, what do you think about this guy Trump? So I don't hold back. And this other fellow stepped in. No, we need someone like Trump because, our taxes, we need our taxes cut. Our taxes are too high. And I knew this guy, I won't use his name, but I said to him in front of the group, I said, I know because you work for a public company. Last year, your salary was $3 million. Now you're going to pay taxes on that, I get it. And you got $26 million in stock grants. And you just finished regaling us in the story of your 1,000 square meter ski chalet that you use 2 weeks a year, and the rest of the year it's empty. I think you have enough. And he said, no, it's unfair. He said, I'd be unmotivated if I have to pay like 50% on my last dollar. I said, really? You're not going to go to work because of that? I don't think so. And he said, yeah, and all these other people, if we give them money, they just won't work. Really? I said, that's in conflict.
Yeah.
And I looked around the place we were in, an Italian restaurant. There's a waiter in a sort of soup-stained It wasn't a fancy restaurant. Sort of stooped over and he came serving us our food. And I said, look at this my way. I said, that waiter, he's probably been working here since he was 14. Probably didn't get an edge. We're in a small town in Italy. He came to work here. He's been working here. He's now, maybe he's 50, but he looks like he's 70. And here's the world I want to live in. That guy knows that. He didn't have the opportunities. But in the right world, the world I want to live in, his kids have the opportunities. He knows that despite the fact that he's a waiter, his kids can go to university or they can do whatever they want if they have the ability and the desire. Also, I want him to know that if he gets sick, he's not going to bankrupt his family. So there ought to be that. And Charlie said, well, that's his fault. He should have become an investment banker.
Did he?
Yes. And people think that way. People I know. Another friend, similar, very well off, made the point that, well, if we started providing universal basic income, all these young people would just stop working. Really? I don't think so. I don't think we don't work for money, but people think we work for money. There's actually a very good author and a very good short video. Do you know Daniel Pink?
No.
He's got if you Google Daniel Pink Drive, RSA, those 3 words, or 4 words, you'll find a video from the Royal Society of Arts in the UK. That is a brilliant production because of the way they do it, but it's basically the story of his book. You can get it in 10 minutes.
Yeah.
And he went off and investigated, sort of an investigative writer. He said, what motivates people? So do either of you play a musical instrument?
No.
No? But you know people who do. And he asked this question when he gives the talk. He said, how many people here play the guitar in the audience? How many of you are professional musicians? None of them. They wouldn't be there if they were, right? So why do you play? You practice all the time. Why do you do that? Not for money. It's for mastery. So one of the motivators is mastery. I want to get good at something.
Yeah. You read the book Mastery?
No.
That's good.
But what is another one? The other one is purpose.
Yes.
That's very important for some people. They're different weights. Another one is, I can't remember the other 2. There are 4 factors, and none of them is money. And there's lots of research that shows providing financial incentives actually reduces performance in many areas. Now, the area where it doesn't reduce performance is in very repetitive factory-type tasks. Okay, great, but that's probably not where we have the problem.
Yeah.
So anyway, it's very interesting. I think we haven't built systems that we've had historically to administer the, whatever you want to call it, govern, which also means administering the distribution of things, have been built on an old model which said it was all about money.
Well, and then you've actually gone in and distorted what money means. Right? Because naturally any organism wants to grow, and I would consider a typically household, business, government, as an organism. You don't kind of go into, we don't go into the stand-up and be like, we want to be smaller next year.
No, but one of the things I find fascinating here in the startup community is there are, the phrase, the 3 Bs. I'm teaching Kiwis this. It's a Kiwi phrase.
What is it?
The boat, the batch, and the BMW.
Oh, yeah. Okay.
Yeah. I know.
Yeah.
There are a lot of people who, and I admire that.
Right.
They don't have the ambition to grow unended.
Yeah.
They have an ambition to say, you know what? I'm going to do this, and it's kind of a good balance. It's enough. I get to do what I want. I have my free time. I got my boat, my batch, and BMW. I've built a business, employing a few people, my neighborhood, if you will.
Yeah.
And that's it. I'm done. It's not, I'm building $1 billion business. Now, there's nothing wrong with the other side either, but we ought to tolerate and have a mechanism that says these are all choices.
Yeah.
And there's not one is better than the other.
Yeah.
And yet we've built a system which biases it.
And then we put fuel on the fire in certain areas and make decisions that have unintended consequences, which exacerbate that exact thing. So, for example, if you're fiscally irresponsible, you distort what value is. What even, like you said around, you think that maybe venture in the US has gone a bit bonkers. I assume that's based on how much money is going to them and the valuations that they're set. Maybe that is, maybe it's not.
Well, I think that what's happened is, here's an example in venture and why I came to New Zealand instead of there. So one of the reasons my US VC friends said you can't invest in New Zealand is they're not going to be enough good companies. You've got to be able to filter through and pick the top ones, and it's just not big enough. I said, well, I'll go find out, but what do you think? They said, well, we have to look at 1,000 companies to find one that we can invest in. I thought, if that's true, that's a problem, because there's you could just go on the NZ companies registered. There are only about 3,000 new ones a year. That means there's 3 companies a year. That's a problem. So I came down here, and it turns out that's not the case. Wow, it must be these New Zealanders are a lot smarter than everyone else. Unfortunately, that's not true. There's much less noise in the system. Why do they have to look at 1,000? Because 700 of them are just total crap. But because of the abundance of venture and the competition in venture, they get funded at the beginning. They don't succeed. So you look at that and you say, wow, only one of 1,000 would be good. And therefore, if I'm going to make investments, I'd better be sure that I get one of those investments that's going to pay off the whole fund.
Yeah.
So you have a model in Silicon Valley that says, I've got to invest only in unicorns. I've got to get the unicorn. It's going to pay off my fund. Everything else is going to fail.
Yeah.
So here's the changing metaphors. Plant a bunch of seeds in my window planter, my tomato plants, and I'm watering them every day, and this one pops up. Oh, that's a good one. Those other ones aren't very good. I'm not going to water them anymore.
Yeah.
They don't pop up. Good thing I didn't water them. They never came up.
Yeah.
Well, you also pump them with steroids.
Well, that's a separate problem.
And then that kind of creates,
then you have the problem of over-investing. No question. But the point is, when I came down here, I said, wait a minute, my big goal is to really affect something more than make money.
Yeah.
And that effect is, how can I solve this other big problem, which is creating a better economy for everybody? So I want to see more good startups rather than one really good startup. So if I think about it and I look at the companies here, I did a bunch of analysis and I said, my view of the portfolio that I'm going to build is that probably 40% are going to fail. I probably should have invested, but I didn't know that. And hopefully those 40% that fail don't fail because I invested in an idiot or a criminal. They just fail. And I can think of that investment loss as actually my cost of education for the entrepreneur who now knows better, and the next one will be good. And for me, that one really was an idiot. I should have invested in that person. I'm not going to do that again. So that's value. Another 40% are going to kind of break even for me as an investor from the point of view of which I invested. The founders who put in sweat equity are going to get more money than they thought they'd ever have. It might be $1 million, but it's a lot more than they thought they'd have. The earliest investors, their aunts and uncles and angels, they'll get some good return. Because when I come in, I probably won't. I'll get my money back. But if I give you my money for 10 years and you give it back to me without interest, that's not a really good economic model for an investor. Yeah. But it's better than zero. And 20% will have a return, but they don't have to have 1,000x or 100x. They have to have somewhere between 5 and 20x across that spectrum. And if they do, that will be a return that is in the top quartile of all venture. Right. As opposed to the one that says, I'm going to do 100x and zero. Yeah. And if you do that, you've also disillusioned all of the entrepreneurs and everybody else, and it's a self-perpetuating model. And that's what's happened in Silicon Valley. That wasn't the model 40 years ago, right? But it is today, because it's become fiscalized, and it's a fiscal model, not a creation model or a generative model. Yeah. If my funding generates amazing businesses that change the world, that's more valuable to me than doing another, SEO optimization software that makes me $1 billion. Yeah. That's not going to change the world. Yeah. So there's a different model, and we have investors across the whole spectrum. There are some that are just fiscal, and there's some that are so ideal that they don't even care about making money. I have to make money because I get the money from investors, and if I don't make money, I don't get to play the game again. Yeah. But I don't have to become, the top fund. Yeah. So that's a little bit of the social side of allocation. Yeah.
Yeah, that's really good. I mean, I think kind of going back to that 10-person startup becoming $1 billion business, I believe that it also could mean that businesses can find out more with less capital early, which goes back to that creation model.
And we definitely see that. I mean, here's another interesting, I think, something that affects the way I look at the markets that I invest in. So I'm a deep tech investor for several reasons. One of which is I think deep tech is built on real intellectual capital, is more defensible. We could probably cook up some very cool two-sided marketplace that was socially meaningful because it was clothing circular economy or something. Great. And now we're going to expand globally. We go to the US, we sit down, we're chatting about it at a cafe, someone who's over here who knows the US market, and they're going to beat us to the punch because there's nothing we have that can prevent that. If we've invented some cool science-based thing that we protect, we have time to get traction. So that's one reason I choose Big Tech from here, because we're not the market. The market's out there. We have to be able to get traction in the market as a company. The second thing is those are the things that are more game changers. Again, optimizing advertising placement, interesting, maybe the math school, but it's not going to change the world. Finding a new material that allows you to solve big problems, or solution for healthcare or transportation, or those are things that can change the world. And then the third piece of it is that when I look at a company, in this, because I'm an early stage investor, the things I look at are the team, the number one factor of the people, the initial team. There's a phrase that's very well known in the startup world or the investing world, product market fit. We all have to get product market fit. When I invest, I have to find founder market fit. Your product is probably, the one you're trying to tell me you're going to do, probably not what you're going to win with, because you're going to learn something along the way. So I'm not going to say I don't care about it. It's a good indicator of the way you think, but I care about you as founders, and I care about the market you're going into. That's all. The product is just an example of how you are good at thinking about the market right now.
Exactly the same with forecasting, right?
Yeah, it's exactly the same.
Let me see how you have made your assumptions. That's great for me to understand how you think. However, that forecast is never going to be the thing that actually pans out.
There's a famous quote from Clausewitz, and it's been adopted over the years. No plan survives first contact with the enemy. It's a military.
Yeah.
That's even more true in the venture world.
Totally.
Show me your slide deck and your business plan, and I know it's wrong. I don't care. What I care is, have you convinced me that you're the one that can make it happen because you're going to adapt it? I'll give you an example, and this is another place where I think New Zealand is immature on the investor side in venture.
Right.
Individual investors. There's a company here I met the entrepreneur very early on, just finished university. She had this audacious, female entrepreneur, very audacious plan. I loved it. And I didn't invest early, but I invested a little bit later. And recently, they've gone through a bunch of evolution. They've done some amazing things, been going for about 5-6 years. They recently found that their original idea was just not going to happen. Now, they could have given up. That would have been one possibility. They could have kept banging their head against the wall. We're going to make it work. The market doesn't understand. That doesn't usually work. But instead, she made, as the leader, some very difficult decisions. Difficult in any case, particularly difficult when you're a young founder and essentially all the employees are your mates.
Yeah.
And now I have to say to you, you know what? We got to make some changes. Goodbye. She did that brilliantly. And they've now got a plan. Will it work? I don't know, but it's a plan. And I ran into some other investors who were angel investors in this company at the recent event, and they told me, oh, that company's in trouble. It's having struggle. It's really trouble. I love that founder more now than I did before. Because now I know that founder can adapt. Is this the right? I don't know if it's right. But oh my God, if that company that founder has now blows up tomorrow, I'm going to be at her door the next day saying, what are you doing next? I want to invest in that. Because she's demonstrated that capability. And unfortunately, traditional business, methodical business, oh, you didn't match your plan? Or the flip side, I did this in the corporate world. I made my plan. Yeah, but the rest of the market was up 20% and you only planned to be up 5%. Yeah, I was up 6%. You still lost, but you get a bonus because you're up 6%. So I think this is part of the dynamic that's so interesting in the entrepreneurial world, and yet not as, back to the property investment, not as common in understanding here. And one of the things that I'm believing, and I don't yet have all the support for this idea, although I'm finding more and more, is how one thinks about risk is really interesting. So do you think Kiwis are risk averse?
Generally, generally, yes.
You invented bungee jumping and zorbing and going to the top of Mount Everest and ocean sailing, all kinds of very risky things. Of course, some of us.
Physically risky.
Okay, but what is it about physical risk that's different? Physical risk has a very, very high downside. You die.
Yeah, totally.
More so than I lost $100. Oh my God. So why is that?
I don't know.
I think here's a piece of it, and I'd love your view on it too. There is the absolute risk. What am I putting at risk? Hey, I'm going to tie this rubber band on my leg and jump off the bridge. It's going to be great. That's a very big risk.
Yeah.
But then there's uncertainty. I'm going to have some random person on the street tie this rubber band to my leg and jump off the bridge. I'm not going to do that. So now put it in the financial world. If you invest $100 in my venture fund, what's your downside? $100. What's your upside? $1 million. That's a pretty cool thing. If you disperse it, I wouldn't put all of your total wealth in that, but if you manage that, that's a very manageable risk. What's the uncertainty? Oh my God, this company just dumped its plan. I love that company because it was doing X and now it's doing Y. And I hate that uncertainty. And Kiwis don't like uncertainty much more than they don't like risk when you separate it that way. And Americans, I realize, they love uncertainty. It's like we celebrate that. Like, let's go west. We don't know what's over that mountain. It'd be cool. Maybe we'll find something good. Maybe that'll be gold. But we also don't like risk. And so actually people are very analytic about their investments in the US with regard to distributing the risk, which is why we do portfolio investing. I don't know how old you are, but I know you're not that old. If you came to me and I was your wealth advisor in the US, I'd sit down with you and I'd say, okay, you're at this stage of your life.
Yeah.
I don't know if you're married and have kids, but there are a bunch of factors. We would assess your stage of life risk tolerance, and I would advise a distributed portfolio of investments.
Yeah.
It would probably not have bonds in it. It might have public equities. It might have some other. So, you got to put some venture and private equity because you have the tolerance at this stage, the time to recover. If you came to me and you're 65 years old and you just retired, I'd say, property would be a good investment. Maybe you should put your money in bonds because you can't tolerate it.
Yeah.
So that's the trade-off between risk and volatility. New Zealanders don't like volatility more than they don't like risk.
Well, that's why they like property, and actually that's
my point.
And that's why they also actually, in some cases, like if you look at it on a relative basis, like venture is relatively popular, like considering our size and such, and the tax regime. I mean, a lot of people are looking at venture.
The amount of venture as a percentage. Well, what do you mean by equity? The public equities or public equities aren't venture? It's a different.
No, I know. I'm saying that in New Zealand, I hear more people talking about venture, private business investing. Well, let's call it private equity and keep it broad than public equities. Because of that, I think also matched with that is that volatility piece marked every day.
That's part of it. I was talking to my neighbor the other day who's I'm having a long-term discussion about because he's a property investor and not a venture investor. Yeah. And I pointed out that the average return in the S&P index, just the index, not like which one. He said, yeah, but you got to pick. You don't pick and choose. You put it. You just spread it out there. Just put it out there, and it far out returns property. Yeah, but it goes up and down. I said, but you don't take it out when it's going down. Yeah. And by the way, if you're investing it and laddering it, and there's all these techniques that people here don't think about. Yeah. And he said, well, but my property's liquid. I can take it out whenever I want. Well, is that right? You see a house right now. He's telling me about. He's having been selling for a year and a half. It's driving him insane. Yeah. I said, you can sell the stock, or you can say, I don't want to sell it because the market's down. I'll wait. But the thought process is, you're exactly right. He said, yeah, but my property, I don't see it every day. Well, you don't have to look at the stock market every day, but people do. And so it is that.
It's because they're scarred from the 80s as well, in the case of New Zealand. There's a lot of, in terms of equities, not necessarily private equity, which I
No, I understand that. But the point is, aren't there people scarred here from property investment, like right now? Because, so.
No, I know. Like, I kind of, I see it a lot.
New Zealanders spend twice as much as a percentage of investable wealth on dwelling units, housing, than the US people. Yeah. Twice as much. Yeah. On an absolute basis, absolute dollar-to-dollar basis in US dollars, they spend 6% more US dollars out of their investable wealth per capita than the US does. Let me say, if I took that money away, if I were magically the government, I said, can't have that. You got to give that to me. That's a difference of $8,000 per person. US dollars, because I normalized that. Yeah. That's $40 billion US, 60 billion Kiwi. I think we'd fix a lot of the infrastructure and stuff that way. And I'm not even saying take it away from the government. I'm saying tilt the playing field so people want to put that money into private-public partnerships for infrastructure.
Yeah, that's cool.
And that'll raise the level for everybody, including the people who don't have the money. Because now the roads are better, and the schools are better, and the power stays on.
And there's not a density perhaps in where you are, right? And there's actually infrastructure to mean that there isn't a large part of the country that's ultimately forgotten, especially so since COVID.
Exactly. And that would be a way that would create an economic model for and a true democracy, because the decision makers are every individual in terms of the allocation. And all you have to do that is some tax policy.
Totally.
But I also think that if you go back to Daniel Pink and you delayer that, you'd realize that it's not just the incentives you're talking about, which are primarily fiscal incentives. There are other incentives. And if we started to have the dialogue around how do we make this a better place for everybody, you would affect not all of them, but some of them. And an example would be, why is it that wealth managers here don't think in this portfolio sense? I'll give you an example. I'm trying to get some wealth managers interested in venture. Told them all about it. They got very excited. The last two questions they asked me were, so do your companies pay dividends? No, because they're growth companies. If they pay a dividend, I'm going to fire the CEO. They're supposed to invest that to grow the company, to give value to the investor. Oh, well, if we steer some of our clients to your fund, are you going to give us something?
That's what I'm saying about...
Which is illegal, apparently, in New Zealand.
Right. So it's illegal...
It's illegal to pay for play, but it goes on in a subtle, hidden form, apparently.
Trading commissions, I mean, the whole...
Well, if you're my wealth advisor, you can't get paid for what you invest in on my behalf. Because you have fiduciary responsibility.
But I can tell you to go and join X Kiwi Saver or use X insurance company and get paid forever. A little trading piece.
You shouldn't be.
Oh, that's the whole industry works on that.
I know it works on that. I didn't say it was illegal.
Okay.
I said it happens.
Right.
And in the US, they made this highly illegal. If you are my wealth advisor, you have 100% fiduciary responsibility to me. And you cannot take money from anyone else. Now, what that means is people look at the US and say, I can't believe you have to pay 1.5% just to get the advice. Well, that's because the guy gets money from nowhere else. I know he's giving me this. So this is what happened because the large financial organizations like Fidelity or others had advisors. So my advisor is Fidelity advisor. Guess what funds he steers me into? Fidelity. Even if he didn't get paid directly. That's not allowed anymore.
Right.
And we don't have that kind of thing. I don't think I'm exaggerating when I said it's illegal. It's a problem. And so apparently, as long as you disclose it, it's legal.
That's right.
Okay, great. Am I reading the fine print? It's like, did you read the EULA on the software you're using? No one ever does. We're probably violating all of it. They don't come after us unless they want to. And that's the same problem. So wealth advisors can get away with this because nobody's come after them, including the regulators. I don't think that's necessarily an easy to solve problem, but maybe there's an opportunity for a wealth advisory to say, you know what? Here's our model. We don't get anything on the placement side. We only get it from you. And we are 100% for you. And by the way, if you're not gaining asset value, we're not growing our business because we get a percentage of your asset value. Either you put more money in because you like us, or your value grows because we're growing it, and we make money that way. We're on your side. It's the same reason why you think employees should own equity in the company. It's the same alignment.
Totally.
But that isn't the way wealth advising is done here.
I know. And that's a big part of our ethos, is trying to change that for sure. Because it's the most expensive country in the world to consume financial products. As well as Australia. So, it's a big part of our mission.
But it's not just the cost of them. It is the cost, but it's also the value of them. If you can tilt the value, so I might be willing to pay that price in this market, the cost, if I knew that you were aligned 100% with my interests. I'm paying for it twice. In a way.
That's right. And it's a education thing because you have to actually teach that you are paying, by the way. And you are paying forever potentially, and you may never meet that person again, or the transfer of value is not clear. There is a product, and it is then
that's right.
Consumed. Then okay, I've done.
Well, and this is the other thing which I mean, here's an example that I concocted. Imagine if I went to every property owner and I convinced them, take 1% of what you have in property, invested in property. In other words, go to your bank and ask them to increase the amount of the mortgage, 1% of the asset value. Most banks would look at it and go, whatever. Now you have a new mortgage bill. It's that money plus 7% or whatever the rate is. But it's not going to break the bank in terms of underwriting. Take that money that you just got from them, because you took that out, and give it to me, and I'm going to invest it in venture across the board. And let's say venture returns on average 10%. That's on average twice what you're getting probably in property over the long haul. Maybe it's 6 to 10. So it's property 60% of that. But what happens if it actually happens, you're going to end up overweighted in venture. Give you the money back, and now you go put more into property. That's the rebalancing, which they also don't think about.
Yeah.
What if you lost that money? What if you lost that 1%? What if it went to zero, which is unlikely and distributed? What if it did go to zero? Oh my God, you took 1% and went to zero. I said, yeah, we did. So the 6% nominal return on your 100 units is now 6% on 99 units. What does that really mean? That's the same as 5.95% on 100 units.
Yeah.
So you lost 0.05% on your return rate for the possibility of upside.
Yeah.
And by the way, the numbers aren't stable. You're not even notice it. It's in the freaking noise.
Yeah.
But we don't have people thinking about that. We don't have people who say, my job as a financial advisor is to work with you over the long term to continually re-examine this. Oh, you just had a child, we should rebalance your risk. You just got, whatever.
Yeah.
That's what people do so that it becomes a long-term relationship in the US market.
Yeah.
That isn't what happens here. It's transactional,
It's
which is ironic
transactional.
because this is such a relationship country.
Yeah.
And the US is a transactional country.
Yeah. I mean, I think there's some people, they're always good actors in the market.
They're good actors, but it's not that.
And I think there's people trying to change that. And I think the regulator is absolutely going to look at the trading commission regime and the disclosure side of things. And I mean, we hope that over the next 10 years that kind of does change. And actually, then you're getting that relational side, which is what you need when investing, because investing is often about kind of staying in the boat, and it's kind of psychological in many ways. But it's been awesome chatting to you. We have had such a diverse set of conversations, and I look forward to.
We didn't even talk about rugby.
Yeah.
No, thank you. So thanks, Mark. Really appreciate it. Cheers.
Thank you.